Welcome to Market Movers. I'm Jim Urio, and we're a couple days away from the single most important data point left for the Fed to chew on before the June meeting. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, the last three jobs reports have been in order: a big beat, a big disappointment, and a small beat. Is there a number that could bring expectations down from the current 88% for the June meeting down to below 50%?
So hot, cold, and then just about right as the fairy tale jobs numbers go. I believe this number is going to be relatively good. I would lean more towards that modest beat territory just because I believe that when we're seeing the consumer confidence numbers, the business confidence and spending numbers, those still portend a decent pace of hiring in the U.S. economy.
Okay, and so, but what about the question is that, is there, if the number comes out as a 50, like a bad disappointment, do all of a sudden we take away any expectations?
Yeah, I tried to avoid your question.
I know, you can't.
It's an interesting thought, though, because is now the market concerned that the Fed's going to move too fast? Or does the market want the Fed to still be somewhat dovish with respect to what's going on in D.C. and the policies that aren't coming through?
Okay, now before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements are going to vary in these markets, and the current underlying is the June contract trading about 24.0607. Scott.
Yeah, 2406 on the ESE Mini. And it's interesting looking at the market today and figuring out where the appropriate protection or maybe aggressiveness you want to put on in your portfolio is. And just given that commentary we had about the Federal Reserve and how they may or may not be feeling, I mean, who knows? I looked at some protection today because that to me looked relatively well priced. So specifically looking at the 2380-2400 put spread on the ES. Now this will expire on Wednesday, June 7th. So you get through the non-farm payrolls report Friday. You and I both agree the market likes to digest things a little bit. And ironically, so by Wednesday that hopefully fills out. Now ironically, the move on that, the lower band of that 2380 is halfway of the move that we saw off the lows that Thursday morning off that big Wednesday sell-off 2 weeks ago. Yes, stay with me, as well as halfway up to that high. So therefore, I believe that's an area that could be filled out with any weakness or any surprise in the jobs front.
What I find interesting is that a year ago, we would always talk about the options that expire that day. We realized that sometimes the move that follows unemployment takes
sometimes
a few
Friday's
days
a thin trade
to develop, and sometimes Friday's a thin trade. So I'm also looking at the Wednesday one too, but I'm looking at the Wednesday, June 7th, the 2420 2430 call spread for 2 ticks. As always, yours is wider, so more reward if it happens and you pay more up front. Mine's you pay 2 ticks up front to make a potential, so $100 risk to make a potential $400. Now the thing is that if you told me, I'm buying a call spread. I'm not that much of a bull. You're buying a put spread. I'm not that much of a bear either, but it's been so coiled that I do think it's capable of making a big move.
I agree with you there. And with mine, too, there's a similar risk reward there, about $200 of outlay to make a potential 800 or so because of that value that I believe you have in just seeing a little bit of opportunity to come back into the markets via what's coming into seasonably a tough time calendar-wise for the markets anyway. So any volatility there will be welcomed with respect to how these two trades are positioned.
Okay, one more question. When the Fed started really talking tough about tightening, it seemed like they really believed that macroeconomic policy was coming down the pipeline that was going to be pro-growth. Do they still believe that? Are they going to change their tone soon?
I think they could change the tone soon. Now, the jury's still out on a lot of that information, but the trends in the market, the underlying currents, I believe, that are in there are slowly starting to tell you that story.
Well, thanks for joining us in this special edition of Market Movers. I'm Jim Urio, where we're helping to make you a better trader.